Semiconductors went up this week. The companies that buy semiconductors lost $797 billion in a single day. Alphabet raised its AI spending plan by $15 billion, and lost 7.8%. Micron, which sells the memory that spending buys, gained 8.5%. And here's the line nobody printed: 8 of 11 sectors closed green this week, and the S&P still finished lower. So the verdict is not risk-off. It's rotation, but rotation inside the AI trade, not out of it. I'm Big Z. This is your weekly brief for the week of July 20th. 4 triggers on the board last Saturday. Let's grade them in public. 1. The S&P's 50-day average, reclaim it or test the 200-day. It failed, closing at 74.11 against a 50-day at 74.72. But it never went near the 200-day. Half right. 2. Credit passed 3% and this stops being rotation. Spreads went from 2.73 to 2.77. 4 basis points, in a week the Magnificent Seven shed nearly $800 billion. Hit, 4 briefs running with no blink. 3, and this is the call of the week. I said the tell for a real bottom in chips is simple: it stops making lower lows on bad news. This week the news was as bad as it gets: a Korean chip crash and a capex shock out of Intel, and the July 17th low at 11,674 held. The semiconductor index finished the week up. Hit. 4. The Kimi K3 waits. Still pending, still dated Monday. 2 hits, 1 half, 1 live. The headline numbers are almost boring. What's underneath them isn't. The S&P 500 fell 0.6% to 74.1198, a second straight weekly loss. The Nasdaq Composite fell 2.1, the worst of the 4. The Dow lost less than 0.4. The Russell 2000 fell 1.1. Now the number that changes the reading: VIX fell. Down 1% on the week, to 18.6. The Nasdaq lost more than 2%, the Magnificent Seven had their worst day since April 2025, and the volatility market shrugged. Fear events bid volatility. Positioning events don't. This was positioning. 8 of 11 sectors finished green. The index finished red. Energy led, up 3.4%, as Brent crude ran to $98. Utilities added 2.5, industrials 1.8, materials 1.4, real estate 1.2. Technology, yes, technology, closed green. The 3 red sectors, staples down 1.2, communication services down 3.9, and consumer discretionary down 5.2. An 8.6 percentage point spread, best to worst. And look at what's in those 2 worst sectors. Communication services is where Alphabet and Meta live. Consumer discretionary is where Tesla and Amazon live. This wasn't a sector sell-off. It was 4 stocks dragging 2 sectors, and 2 sectors dragging an index. So is the average stock in trouble? No. And the data isn't close. The equal weight S&P rose about 0.1%. The cap-weighted S&P fell 0.6. Equal weight won by roughly 0.7 percentage point, the second week running, after 1.11 last week. Year-to-date the gap is wider still, equal weight up 11.5%, cap-weighted up 8.4. 3 full points of this year's return is now an average stock story, not a megacap story. And the 10-year Treasury yield rose 14 basis points to 4.68. Rates went up, and utilities and real estate still rallied. That only happens when money is hunting anything that isn't a technology megacap. Now the part everyone got wrong. If you read the recaps this week, you saw headlines about chips in a bear market, worst weekly decline in a year. Those numbers are real, they're just last week's. Here's the actual week. The Philadelphia Semiconductor Index rose 1.24%. Underneath it, Teradyne up 8.5. Micron up 8.5. SanDisk up 6. AMD up 5.3. Broadcom up 3. Nvidia up 2. And the structural read, that index is still 19% below its June 22 record, with its 50-day average almost 1,000 points overhead. So this is not a recovery. It's a floor test, and this week, the floor held. That's the setup. Then Friday happened. Yesterday, chips gave back half the week in one session. The semiconductor index fell 4.25%. SanDisk dropped 10.8%. Intel fell 7.9%. Marvell 7.2%. Micron 7%. Applied Materials 4.7%, Lam Research 4.6%. And Nvidia? Down 0.9%. Again. For the second week running, the most obvious AI stock on earth was the least damaged thing in its own sector. Now the important part, why? There was no American catalyst. The trigger was an overnight sell-off in Seoul, led by Samsung and SK Hynix, and it flowed straight into US memory names because those names now trade as a basket with the Korean index. Here's my read. A one-day move with a foreign trigger and no domestic news is a liquidation, not a re-rating. Micron ended the week up 8.5% including that 7% Friday. The week beat the day. But I'd be lying if I said Friday didn't put my floor call on notice. Here's the thesis, and it's the whole episode. 3 companies reported this week and told investors the same thing: we are going to spend more on AI. All 3 were punished. Alphabet raised its 2026 capital spending guidance to as much as $205 billion, up from a ceiling of $190 billion, and warned 2027 goes higher. It fell 7.13% Thursday, its worst day since May 2025. Tesla reported a record quarter, then Elon Musk called 2026 a massive capex year. The stock fell 17.8% on the week. Intel is the cleanest tell of all. Revenue up 25% year-on-year, its fastest growth in over 15 years, earnings roughly double expectations. The stock popped 13% after hours. Then it raised its capital budget from $18 billion to over $20 billion, said 2027 would be significantly higher, and fell almost 8% the next day. A blowout quarter, punished for the spending it takes to repeat it. Now the other side of the ledger, Micron up 8.5%, Teradyne up 8.5%, AMD up 5.3%. Micron and Alphabet finished more than 16 percentage points apart in 5 sessions. That is the whole regime in one number. The market has stopped asking who wins AI and started asking who pays for it. Suppliers collect. Spenders write the check. If you want the full teardown of the AI compute chain, who collects, who pays, and what happens when the capex cycle finally turns, that deep dive is coming. Subscribe so you don't miss it. 3 signals the mainstream recap skipped. 1. The best trade of the week wasn't a stock market trade at all, it was freight. Frontline rose 7.7%, International Seaways 6.4%, DHT 6%, Scorpio Tankers 3.9%. Every one of them beat every S&P sector. The driver, VLCC spot rates from the Gulf to China jumped 24% in a single day Friday, the steepest move of the year, with both Hormuz and Bab al-Mandeb disrupted. The oil trade this week wasn't a barrel trade. It was a shipping trade. 2. There was a split inside semiconductors that nobody flagged. Teradyne, test equipment, rose 8.5%. Lam Research and Onto Innovation, the wafer fab equipment names, both fell 2.6%. An 11-point spread inside one sub-industry, in 1 week. Test gear is levered to units shipping right now. Wafer fab equipment is levered to capex committed years out. It's the same trade as Micron versus Alphabet, one layer further down the stack. 3. The uranium ETF rose 3%, the 4th brief in a row this thread has paid. But keep it honest, still 25% below its early summer high. A recovery, not a breakout. A quiet data week that quietly repriced the federal jobless claims came in at 221,000 against roughly 235,000 expected, the lowest reading in 5 months. Strong labor, into an oil shock. That's a hawkish combination. Because oil was the real macro event. Brent rose 11.7% to $98, touching $100.70 Thursday before a report that Pakistan, pushed by China, was exploring a path back to US-Iran talks. And the Fed got repriced hard. 10 days ago, markets put the odds of a rate hike at this month's meeting under 11%. By Friday, published estimates ran between roughly 38 and 46%. Nobody is discussing cuts. That entire move is the oil price. On new listings, a thin week, with one telling data point, an AI company raising about $1 billion priced its IPO $2 below its range. When the primary market won't pay full price for AI, that beats any strategist's note. Next week is the densest of the quarter, and it starts Monday. Monday, Moonshot's Kimi K3 open weights are due, 2.8 trillion parameters, about 1.4 terabytes, needing 64 or more accelerators to serve. Read that constraint carefully. This is not a laptop download. It's a gift to whoever already owns data centers. Wednesday, the Fed decides at 2 p.m. Eastern, no projections, Chair Kevin Warsh at 2:30, and on the same afternoon, Microsoft and Meta report. Thursday, Apple and Amazon, plus GDP and PCE in the same 8:30 print. Now your 4 triggers. On the S&P, 7472 is the 50-day. Reclaim it and this 2-week wobble is over. On chips, 11,674. Lose that and my floor call is wrong and the bear market has a second leg. On credit, 3% on high-yield spreads. And on oil, $100 on Brent, above it, hike odds keep climbing and this stops being a capex story and becomes a macro story. One cross-market note to finish. 2 of this week's 3 biggest movers came from outside the United States, a Korean chip sell-off and a Middle East supply shock, and both hit U.S. assets harder than anything in the domestic data. The bottom line, chips found a floor and the people buying chips found a ceiling. Watch the spend, watch the level, watch the freight. That's your weekly brief. I'm Big Z, follow me, see you in the next deep dive.